high 90% accuracy. So you're learning how I don't need to be in there everyday trading and how you don't need to be in there everyday trading. You're not trying to romance the outcome of everything that you do as a trader. You're embracing the uncertainty. That's different. You're embracing that hard right edge where you know that you have tools and perspectives and processes, protocols that you can follow that remove the need to be right. How many times have you watched that opening gap go back to its mid gap since I now taught it to you? Very few, very few times that it fails to do so, but more inclined to do what? What I said. And I can promise you, over the last 40 years, 4 decades, it's done that. Not just in the NASDAQ market, not just in ES, not just in Dow, but in currency futures, the bond market, the grain markets, the meats, the metals, all of that. Every market out there that you can measure this phenomenon, and it's there. Even if it doesn't have a separation of time like we view indices, like indices have in electronic trading hours, they stop. And they have a regular trading hours time where they stop and they restart at 6 p.m. And then we have regular trading hours starting at 9:30 a.m. It's important to have that information because that information gives you a perspective that the general public doesn't perceive. They don't see it. They may recognize there's a gap, but what do you do with that gap? See, by far and large, the average person that is aware of a gap, they think, okay, well, gaps at the opening generally like to be traded down into or up into. Okay, once it does that, then what? Well, I don't know about that, but this is what we can see. This gaps like to get filled, and the chop is real. What do you do when the gap is a premium gap? It opens higher. We trade down to fill the gap, and then we keep going lower. What does that tell you? Well, I don't know. I do. My students do. You're learning that. But you need something that's going to encourage you in the beginning. And by having something that has a 70% likelihood of panning out, why do you think I want a 75 handle or more opening range gap? What is half a 75? It's an easy 25 to 30 handle run. And that's all you need. Once you get that, you can turn your charts off and go fishing, go to the movies, take your significant other out for a date, go have lunch, go back to bed, play some Xbox and PlayStation, whatever you want to do. Go to the gym because your day's done. Think about how fast the 70% repricing to mid gap went into large range gap. How many times have you seen that happen? How many times have you seen it physically happen? Just like that. And how many of you thought to yourself, if push comes to shove, if this is all I get good at doing, how's that a failure? How is that not a clear model that could take your fucking ass right out of that job that you're worrying about every day losing and why you're not getting the raise and how much more time you got to put up with fucking Carl? This fucking guy is constantly looking over your shoulder asking, so how's that trading going? How's that Forex trading going? You ready to quit your job yet? You gotta be a lifer like me. You know you are. Yeah, your corporate team. Your corporate team, baby. You are never getting out of here. I told you when you first told me this stuff, it's never going to work for you. Looking at that opening range gap, understanding how it behaves, what you can do with it will separate you from putting up with Carl's bullshit. You won't have to go and work at that asshole anymore. But you have to submit to the time to getting good at reading it, not over leveraging, but one contract, one of them traded 3 instances over a week. You get two trades, 1 trade. See what I did there? Approach it back to just 1 trade, 1 good trade a week. And it could be just inside that opening range gap. And you don't need to know where the draw on liquidity is right now. You have something that can feed you, put some grocery money in your pocket, pay your mortgage note, or half of it, or a portion of it. And that little tiny victory, that little tiny footing, that sure footing underneath your feet will give you the confidence and to remind you, you know what? I made the right decision doing this. Something pushed me into this pathway. It didn't happen by circumstance. It didn't happen because of, just, luck. You were placed in my path for a reason. We came together for some cosmic reason. Okay. And all you need to do is give yourself the opportunity to taste it one time, following the rules. And when you do that, you'll have every bit of the confidence to lean back on that one moment, that one instance where it happened in your hands. The bug will have bitten you. You will have been infected with it. You're ICT positive now. You're infected. And you'll go in looking for these types of things, these smart money signatures, and it'll encourage you because you've tasted it. You've seen it happen in your own hands. And it'll give you confidence to go in and keep doing more and more and more. And as you find more opportunities where you follow the rules and it pans out in your favor, it rewards you for following the rules. It does not punish you for being patient. It rewards you for being patient. It rewards you for being diligent and selective and in looking for this weak-handed arm wrestling match against ill-informed people that pretend that level 2 data gives them some kind of advantage, that pretends that volume profile has some measure of importance over price. It has no importance over price. It's only showing you what's already happened. It's not telling you where it's going to go. But understanding how looking at less informed traders and how they think about the market, how they internalize what price is likely to do. And when they get sentiment driven, a gap opening higher, the public's going to eat that up and think it's bullish. And when they start to run up a little bit higher, you're going to smile and you're going to say, I'm not buying that. That's the Judas swing. Because inside that opening range, that first 30 minutes, a Judas swing is going to form. And the gap is telling you right away where the initial draw is going to be. A gap higher, okay, you're looking for mid gap. Is there a range in there for 25 to 30 handles? You have a shoe in easy lead pipe cinch trade. All you got to do is wait for it to come down below a buy sign, balance, sell sign deficiency if it's gap up higher. Once it breaks below that, look for that gap to act as an inversion fair value gap. That's all I did Friday. That's all that was. That was not me painting a fair value gap to go long in. When the whole time in that morning I was saying I would not be buying this. I would not be buying this. I would not be buying. I told you, even if it ran up to primary buy side, I would not be in that long. Why? Because I taught you the opening range is going to be like a black hole, a vacuum that's going to pull price down into its midpoint. And how it trades to that midpoint in terms of the speed, how fast it gets there, and what does it do as soon as it hits it? Does it pierce right through it? Or does it repel back up? Or does it trade down through it and come back up and treat it as resistance, as a premium array, and then sell off even more and go for 3/4 gap closure? So we're not fooled by these assholes on social media anymore. They want to take things out of context because you have documented facts being shown to you in live stream. I'm not ambiguous. I'm telling you what I want to see, what I'd prefer to see, and where the actual PD arrays are talking, where they're saying this is what's likely to do. And if you can't see that, you're lost. You're lost and you're untrainable. You're unteachable. I can't do anything for you. Every instrument has an algorithm price engine that literally drives the market up and down, and it attacks
resting orders. It entices buying and selling. There's no buying and selling pressure driving it up. No more than the 3 or 4 ticks above the high that has a standing base of orders, maybe in tune of 250 contracts. But 2 ticks above that, there's another 300 handles, 500 handles, 10 handles above that, but it stops just above to bump those, leaving all that real juicy liquidity. You mean tell me that nobody's interested in being a buyer? That they can't just rebook and send that price higher to higher to higher just to absorb that liquidity up there? They don't want it there. That's why it never goes there. It's controlled. They leave that up there because when they start sinking the market, more shorts are going to enter the market and that liquidity increases. Because what you're watching is the net longs that the smart money's holding, they need to exit the liquidity to exit out of that. So they want to build these big pools of liquidity above old highs. That's why turtle soups work. That's why they work. Linda Rash's book never covers that, and you can go and look at her book. Look and see if Larry Connors and Linda Rash mentioned that's the reason why the turtle soup forms. They just say they're capitalizing on a pattern that historically has been proven 70% effective by being contrarian to what the turtles traders methodology was, which was buying a breakout of 20-day highs and lows. You ever seen me using a 20-day high and low? Fuck no. But the concept of a false breakout, which I didn't invent that, they didn't even invent that. They just gave you a specialized system of entering around that idea or premise, which is why I think the book was great when I first got a hold of it. I paid $175 for that book. I don't know what it goes for now, but I don't regret paying that much for it because it gave me an insight about stop hunts that it solidified a concern I had that validated it for me. Because if these people are writing a book about it, then they saw it too. So if they saw it too, then hey, man, to me that validates it. It wasn't something that I'm just feeling like it's it's limited just to me, which in trading can trick you. But if it's a large sample set of data suggesting something that's there, then the premise is probably having weight to it. Knowing how a turtle soup will form before it forms, same premise. A turtle soup can form right before a macro or just after a macro begins. But knowing the narrative of how that daily candlestick is going to form a down close day or an up close day is going to be understood based on where the liquidity is and how we start the day. Is it going to rally first and create the high of the day, or is it going to sell off initially, trick people short, leaving relative equal highs that they run for later in the day? That creates the high of the day, and the only thing they're really running out is the engineered buy side liquidity. Then send it lower for the close, and that's your narrative. That's the bias is short, but it isn't always open, go straight down, close. How we trade initially after the opening, because in a perfect world, what we want to see is when we're bearish, it opens, rallies up, and takes out the liquidity above 7 to 9 o'clock in the morning, or London high, or Asia's high. And we use the economic calendar to bridge that, which one do I really want to focus on? But we always, every single day, use the liquidity that's formed just after 7 o'clock Eastern time, prior to the 9:30 opening bell. Those pools of liquidity cannot be hidden from you. And when it's a clear, obvious relative equal high or relative equal low, and it would match how the daily candlestick should form for the purposes of power 3. In other words, you're bullish, your bias is bullish. You think the weekly chart's going to keep working towards a level higher. Okay, wonderful. That means you're going to be looking for easy bread and butter idea is at 7 o'clock in the morning, go to 9:30. At 9:30, in that last 90 minutes, where is the relative equal lows? If there is no relative equal lows, just find the lowest low if it's a singular low. That's where you're going to expect the price to drop down in a perfect world. But because we have to watch and see what the opening range can do for the first 30 minutes, unless it just does exactly what we're expecting right out the gate, which is a Judas swing, and when we're bullish, it drops down and goes for the liquidity. Then you know what you're waiting for. Go down there and get it, soup it, use the first resistance fair value gap that you come to after it runs the liquidity. Okay, it's a little variant on the gauntlet. It doesn't have to have a breaker there. Okay, so running, I have to slip that in there, and people that didn't stay on, they didn't hear that. But the raid after going down to hit that sell side, even if it's going to go lower, the chances of you getting 50% of that drop down, that many times can be a trade. It can yield you 20 handles. It could yield you, and in today's volatility, it could be as much as 50 to 100 fucking handles. It's relative to what you're seeing in terms of volatility at the time when you're looking at the market versus, well, guessing what it's going to do. Yeah, there's a process of you determining what liquidity it should reach for. Perfect world, it drops down for liquidity, makes the low of the day, and then all day long, the rest of the day, it just keeps going higher. That's a perfect classic buy day. They happen about 4 to 6 times a year. I'm sorry, a month. Every other day might get like you're bullish, your bias is bullish. The weekly chart you're calling for a specific premium PD array, and then the market rallies first. That don't make any fucking sense. Like you want to see it drop down. I mean, what do? You wait, and then if it's left relative equal lows during the opening range, it's going to come back down for the silver bullet to get that. And then run higher going into the lunch. And then whatever short-term high that's in the middle of that run, it'll bump down into that during the 2-hour lunch period, hit that liquidity, and then expand for the rest of the day, giving you the classic up close